Hello everyone, Ray the Tax Guy here, back with another video, and in this one we're going to dream a little bit. We're going to talk about the lottery. Let's have some fun.
You got all 6 of them!
Yes, we won!
Alright, so congratulations, you just won the $1.35 billion Mega Millions jackpot. That's going to be the second largest jackpot in the history of the game. So, what do you do now?
What you gonna do, Derek? Show me the money!
Do you buy yourself a Bugatti? What about some bling? Do you buy yourself some bling? Or do you just go to Vegas, put it all on 7, and let it ride? No, you don't want to do any of these things, okay? So in this video, we're going to talk about some tips or things to do if you hit that Megalicious jackpot. Let's get to it. All right, so first, let's talk dollars. How much of the actual jackpot do you really get to keep? All right, so there's really two ways to receive your lottery winnings, right? You can get the cash option, or you can have the annuity, and there are differences between the two. Let's talk about the cash option first. So normally you'll receive your lottery winnings anywhere from 3 to 4 weeks after you've claimed them. And with the cash option, the payout is usually about 52% of what the total jackpot is. So for this particular jackpot, the cash option will yield you about $707.9 million. But wait, the fun doesn't stop there. There is one thing that's going to happen. Well, there's several things, but there's one thing that is going to happen before you see any of that money.
It's the worst part of the game. Oh, it's what? Taxes.
That's right, taxes. So the IRS is going to withhold about 25 million or 25% of that money that you receive, which ends up being about $177 million when you round up. Now, if you're one of the fortunate ones to live in a state like New York that taxes lottery winnings, there's an additional 8.82% of that lottery winning that goes right to the state of New York. So that's roughly about $62 million that you'll have to pay to the state of New York before you even see the money in your bank account. So after all is said and done, you'll see about $468 million. That's what you'll have to play with. But there's also income taxes.
No! God, please, no! No!
So you have to account for those taxes while you're preparing to spend your money. But this is where tax planning actually comes into play. So if you select the annuity option, the payments are broken up into about 29 equal payments throughout the year. But what does that actually look like? Well, right from the beginning, you'll get the withholding, the 25% on the federal side. And if you're fortunate enough to live in a state like New York, you'll get the additional 8.82% that you'll have to pay in taxes to the state before you even see any of that money or before the annuity is even calculated. After the math is done, that's roughly around $893.4 million broken up into 29 equal payments that you'll receive each year. Now, each payment increases by 5% per year. So the first year, you'll receive about $30.1 million. The second year, you'll receive about $32 million. And it increases 5% until the 29 payments are exhausted. All right, so the 3 or 4 weeks have now passed. What do you do now? Well, the first thing you want to do is make sure you pinch yourself, okay? Make sure you're not dreaming. After you're done making sure you're not dreaming, the next thing you want to do is hire professionals.
You're Jimmy, right? This is your house?
Sure is.
I'm Winston Wolfe. I solve problems.
Good, we got one.
So I heard. May I come in?
Yeah, please do.
You want to make sure you hire 3 key people: a lawyer, a tax specialist, and a financial advisor. Once you've assembled your dream team, now you can start the planning process. This planning process can consist of many different investment vehicles, but we're going to talk about just a few. First, life insurance. Life insurance is the easiest way to transfer assets from one generation to another, and it's usually tax-free. These policies can be structured in a way that will significantly decrease the amount of taxes that you are actually paying upon your death. And they're effective regardless of whether you use the annuity option or the cash option. So the Dream Team can help you formulate the right life insurance structure to lower the liability on your taxes at the end of the year, and then of course upon your death, the estate tax. The second planning strategy is going to be irrevocable trusts. Now these can get a little bit technical, so I'll spare you the torture, but it's essentially a separate entity. So once you gift the money to the irrevocable trust, the trustee manages those assets within the trust, and then the beneficiary receives the money from those trusts. Now it's a separate entity, which means it has its own separate taxable income and separate tax implications. Now you do relinquish control of the money, so you have no more control of that money, and there are no takebacks. Once you sent the money to the irrevocable trust, that is it. This is why it's important that you assemble that Dream Team so they can help you formulate the right irrevocable trust that fits your needs. Another tool to consider is going to be foundation planning. So if you're particularly inclined to give to charity, foundations are great. Creating one of these foundations will ultimately lower the taxable income that is paid throughout the years, and then of course upon your death as well. The government essentially makes you an offer you can't refuse when you set up one of these foundations. So these private foundations are expected to return about 5% of their income to society, and what the government says in turn for your generosity is, okay, we'll allow you to take certain deductions on any cash that is used or gifted to this foundation, as well as any property or long-term assets gifted to this foundation. Again, these can get really complicated, so it is always a good idea to lean on that Dream Team and make sure that they structure the right foundation for you. So that was pretty much it. There are so many other investment vehicles that are tax-free and strategies that you can use. It'll take 5 hours to discuss all of them. But the first thing you want to do is make sure you assemble that trifecta, that Dream Team, the lawyer, the tax specialist, and the financial advisor. And in the long run, they're going to be well worth their money. That was it. Thanks for stopping by. It would mean the world to me if you go ahead and hit that like, subscribe to the channel, and then leave a comment down below. Let me know what you think. Let me know other videos that I should come up with, and I'll catch you in the next one.